Stop whatever you're doing right now. Put down the sandwich. Yes, even if you just took a bite, spit it out if you have to. This is more important than your lunch. Tell your boss you'll be back in some minutes. Tell your wife you will take out the trash later. If you are driving, pull over. If you are in the shower, get out. Are we clear? Good. Ladies and gentlemen, Asian guy here. It is Tuesday, January 13th, 2026. And I'm about to tell you something that is going to make your blood boil. Yesterday, Monday, January 12th, we watched silver break through $85 per ounce. We watched the Shanghai Futures Exchange trade at $93. We celebrated. We talked about the death of the arbitrage. We talked about how the paper market was collapsing and the physical market was taking over. We talked about how the system was breaking in real time. And then last night, while you were sleeping, while you were scrolling through TikTok, while you were binge watching some Netflix show you're going to forget about in 3 days, the empire struck back. The Chicago Mercantile Exchange, the CME, the entity that controls the COMEX futures market, the entity that sets the rules for paper silver trading, sent out a margin notice advisory. Well, so in that notice, they announced that effective immediately, not next week, not next month, but today, Tuesday, January 13th, they are changing the rules of the game. They are changing the entire margin system for silver futures. And they are doing it in a way that is specifically, surgically, precisely designed to crush retail traders, to force out the little guy, to liquidate the small investors, to protect the big banks who are short and losing billions of dollars. This is not a conspiracy theory. This is not speculation. This is documented. I have the numbers. I have the math. I have the historical precedent. And I am about to walk you through exactly what they did, why they did it, and what it means for your money. But before I do that, I need you to understand something. What you're about to hear is going to sound crazy. It is going to sound like the kind of market manipulation that people joke about, but never actually believe happens in real life. It is going to sound like something from a movie where the villains control the system and rig the game. But it is real. It happened last night. It is happening right now as you watch this video. And if you do not understand it, if you panic and sell because you see a red candle on your screen, you're going to miss the biggest wealth transfer of your lifetime. So buckle up, focus, and let me show you exactly how the game is rigged. Here is what happened. The CME sent out a margin notice yesterday evening, Monday, January 12th. The notice stated that they are changing the margin requirements for silver futures contracts. Now, if you have never traded futures, let me explain what margin requirements are. When you buy a futures contract, you do not pay the full value of the contract up front. You pay a fraction of it as collateral. That fraction is called the margin. It is like a security deposit. For example, one silver futures contract on the COMEX represents 5,000 ounces of silver. At $85 per ounce, that contract controls $425,000 worth of silver. But you do not need $425,000 to buy that contract. Under the old rules, you only needed about $32,500 as margin. That is the beauty of futures trading. You get leverage. You can control a large position with a relatively small amount of capital. With $38,500 margin on a $425,000 contract, you have roughly 13 to 1 leverage. For every dollar you put down, you control $13 worth of silver. This is how retail traders, people like you and me who do not have billions of dollars, can compete in these markets. We use leverage to punch above our weight, and the banks hate it. Because when retail traders use leverage to go long on silver, when we pile into the market and start demanding delivery, it threatens their short positions. It threatens the whole paper Ponzi scheme. So what did the CME do? They changed the rules to reduce our leverage and force us out. Here is the specific change they made. Under the old system, the margin was a fixed dollar amount, $32,500 per contract. It did not matter if silver was at $50 or $85 or $100. The margin stayed the same, fixed. Under the new system effective today, the margin is a percentage of the notional value, specifically 9%. What does that mean in English? It means the margin is no longer fixed. It is now calculated as a percentage of the total contract value. If silver is at $85, one contract is worth $425,000. 9% of that is $38,250. So your margin requirement just jumped from $30,500 to $38,250. That is an increase of $5,150 per contract. That is a 7% increase overnight without warning in the middle of a historic rally. Now you might be thinking, okay, so they raised the margin by 18%. That sucks, but it is not the end of the world, right? Wrong. Here is why this is absolutely devastating for retail traders. If you are already using maximum leverage, if you had deployed all of your available capital across multiple contracts, you just got a margin call this morning. A margin call means you do not have enough money in your account to meet the new margin. Requirements. Your broker sends you a notification. You have two choices. Choice 1, deposit more cash immediately to meet the new requirement. Choice 2, close your position, sell, get out. Most retail traders do not have an extra $50,000 or $100,000 sitting in their bank account ready to deposit at a moment's notice, so they are forced to sell. They are forced to liquidate their positions at whatever the current market price is. And when thousands of retail traders are forced to sell at the same time, what happens to the price? It crashes. It tanks. Not because the fundamentals changed, not because there is suddenly more silver in the vaults, not because industrial demand decreased, but because the exchange changed the rules to force liquidation. This is market manipulation, period. This is the CME and the big banks changing the rules in the middle of the game to shake out the retail investors who dared to bet against them. And it is not the first time they have done this. Let me give you the history, because this pattern repeats over and over again. In January 2011, silver was in the middle of a massive rally. It had gone from $18 per ounce to nearly $30 in just a few months. Retail investors were piling in, the momentum was building, the squeeze was on, and what did the CME do? They raised margin requirements not once, not twice, 5 times in 9 days. Let me say that again. They raised margin requirements 5 times in 9 days. They took the margin from $6,000 per contract all the way up to $21,000 per contract. And that is a 350% increase in a week and a half. And what happened to the price? It crashed from $30 down to $26 in a matter of days. Thousands of retail traders were forced out. The rally stalled. Everyone thought it was over, but it was not over because the fundamentals had not changed. So silver recovered and kept climbing. By April 2011, it was approaching $50 per ounce. And what did the CME do? They did it again. More margin hikes. And then on a Sunday night, April 24th, 2011, a day that will live in infamy in the silver community, they delivered the knockout punch. They raised margins massively, and they did it when the markets were closed, so no one could react. When the markets opened on Monday morning, the price gapped down. It crashed from $50 to $42 in a single session. Then it kept falling $35, $33, all the way down to $26 by the end of September. That event is known as Silver Sunday. Oh, and it was not caused by fundamentals. It was caused by rule changes designed to crush the retail investors and protect the banks. Now, fast forward to 2026. History is repeating itself. Silver just broke $85. Shanghai is trading at $93. The squeeze is on. The system is breaking. And what does the CME do? They raise margins. They change from a fixed dollar amount to a percentage of notional value. They force liquidation. They manufacture a sell-off. Same playbook, same tactics, same goal: protect the banks, crush the retail traders. But here's the thing. It did not work in 2011. Not in the long run. Yes, they crashed the price from $50 to $26, but silver did not stay at $26. Over the next decade, the fundamentals reasserted themselves. And in 2020, 2021, silver went on another massive run. And now in 2026, we are in the beginning of the biggest silver bull market in history. And no amount of margin manipulation is going to stop it. Because this time is different. This time the shortage is real. This time industrial demand is off the charts. This time China has shut off exports. This time the Shanghai premium is $14 and widening. This time, the physical market is completely disconnected from the paper market. And you cannot manipulate physical reality. You can manipulate paper contracts. You can change margin requirements. You can force people to sell their futures positions. But you cannot force a solar panel factory to stop needing silver. You cannot force Tesla to stop building electric vehicles. You cannot force the Chinese military to stop manufacturing missiles. And you cannot print physical silver out of thin air like you can print dollars. So the manipulation will fail. It will delay the inevitable. It will shake out some weak hands. It will create volatility and fear. But it will not change the destination. The destination is $370 per ounce. And I am going to tell you exactly why. While the CME was busy changing margin rules to protect their banking friends, one of the most respected macro strategists in the world just dropped an analysis that explains exactly what is about to happen to the global economy. His name is Tom Bradshaw. He's been in the financial industry for decades. He's not some random YouTuber. He's not a conspiracy theorist. He is a professional analyst who works with institutional clients. And he just went on ITM trading and presented something he calls the 38% signal. Here's how it works. Bradshaw went back and studied every major economic cycle over the past 50 years. And he found a pattern that has a 100% success rate. Not 90%, not 95%, 100%. Here's the pattern. Whenever gold rises more than 38% in a single calendar year, a severe recession follows within 12 months, every single time. No exceptions. This has happened 3 times in modern history. 1973, 1980, 2008. Let me walk you through each one. In 1973, gold rose over 40% from $63 per ounce to $97. The following year, 1974, the United States entered one of the worst recessions since the Great Depression. Unemployment spiked, GDP contracted, the stock market crashed, inflation soared into double digits. It was a disaster. In 1980, gold rose over 100%, from $512 to $850. The following year, 1981, the United States entered another brutal recession. The Federal Reserve had to raise interest rates to 20% to break the back of inflation. Unemployment hit nearly 11%. It was catastrophic. In 2008, gold rose over 30%, from $833 to $187. The recession was already beginning and it accelerated into 2009. The financial crisis, Lehman Brothers, collapsed. The stock market lost 50% of its value. It was the worst economic disaster since the 1930s. So, the pattern is clear. Gold rising more than 38% in a year is a warning signal. It is the market screaming that something is wrong with the financial system. It is capital fleeing from paper assets into hard assets because people do not trust the system anymore. And now in 2025, gold rose over 40%, from around $3,000 to over $4,600. The signal has been triggered, the alarm is ringing, and according to Bradshaw, the recession is coming. But here's where it gets really interesting. Bradshaw does not think we're just going to slide into a recession and stay there forever. He thinks the pattern is going to follow the same playbook as 2008. First, there will be a short-term liquidity crunch, a moment where everything sells off together. Stocks, bonds, commodities, crypto, everything crashes because people need cash. They need liquidity to meet margin calls, to pay debts, to cover losses. In 2008, gold and silver actually sold off in the initial phase of the crisis, not because they were bad investments, but because people were forced to sell everything to raise cash. Gold dropped from $1,000 to $730 in a matter of weeks. Silver dropped from $21 to $8. But then, after the Federal Reserve stepped in, after they started printing trillions of dollars, after they bailed out the banks and flooded the system with liquidity, gold and silver exploded. Gold went from $730 to $1,900 over the next 3 years. Silver went from $8 to $49. The real bull market did not start until after the crash. The crash was the shakeout. It was the final liquidation of the weak hands before the big move. And Bradshaw thinks we're about to see the same pattern, short-term liquidity crunch. Everything sells off. Everyone panics. Then the Fed prints and gold and silver go vertical. And here is where it gets absolutely wild. Bradshaw has specific price targets for this cycle. He's projecting $9,000 per ounce for gold and $375 per ounce for silver by 2028. Let me say that again so it sinks in. $375 per ounce for silver. Not $100, not $150, $375. That is over 4 times the current price. That is a 440% return from $85. And he is not pulling these numbers out of thin air. He is basing them on historical patterns, on monetary expansion, on debt levels, on industrial demand. He is looking at the same data the central banks are looking at, and he is telling you that the system is going to break. The dollar is going to lose. Significant value in hard assets are going to explode in price. Now, let me connect the dots for you because everything I have told you so far is connected. The CME just raised margin requirements. Why now? Why in the middle of a rally? Why when silver just broke $85 and Shanghai is trading at 93 hours? Because they know what is coming. They know that Bradshaw is right. They know the 38% signal has been triggered. They know a recession is coming. They know that when the recession hits, when the Federal Reserve is forced to print another $5 trillion or $10 trillion to bail out the system, gold and silver are going to go parabolic. And they know that if retail traders are still holding their positions, when that happens, the banks are finished because the banks are short silver, massively short. They have been selling paper silver for years to suppress the price and profit from the manipulation. But if silver goes to 375s, those short positions become catastrophic losses. Losses that could bankrupt major financial institutions. So what do? They change the rules now before the big move. They raise margins to force retail traders to sell. They create fear and panic. They manufacture a pullback. They shake out the weak hand so that when the real rally begins, when silver goes from $85 to $150 to $250 to $375, the retail investors are not in the trade anymore. We got liquidated. We got scared out. We sold at the bottom. And the banks get to cover their shorts at reasonable prices before the explosion. This is financial warfare, and we are the target. But here's the beautiful thing. They are showing us their hand. By changing the rules, by raising margins in the middle of a rally, they are admitting that they are scared. They are admitting that they are losing control. They are admitting that the fundamentals are against them, and the only way they can win is by changing the rules. And when your opponent is that desperate, when they have to cheat to beat you, that is not the time to fold. That is the time to hold. That is the time to double down. That is the time to look them in the eye and say, I am not selling. Now let me show you the disconnect between the paper market and the physical market, because this is where the lie becomes crystal clear. In the paper market, the CME just raised margin requirements, leverage is down, forced selling is happening, the price is under pressure, traders are panicking. But in the physical market, nothing has changed. Shanghai is still trading at $93. That is an $8 premium over the COMEX spot price. Dealers in the United States are still charging $8 to $10 premiums for physical coins and bars. Some dealers are charging $15 over spot. Mints are still reporting delays of 8 weeks or more for new orders. The physical shortage is still real. The vaults are still empty. Industrial demand is still exploding. The Chinese export licensing system that went into effect on January 1st is still in place. None of the fundamentals have changed. The only thing that changed is the rules of the paper casino. And here is the key insight that you need to understand. The CME can change margins to 100% if they want. They can make it so expensive to trade futures that nobody can afford to do it. They can effectively shut down the paper market. But that does not create a single ounce of physical silver. It does not open a new mine in Mexico. It does not convince China to start exporting again. It does not reduce the demand from Tesla or Apple or solar panel manufacturers. All it does is temporarily suppress the paper price, while the physical shortage continues to worsen. And eventually, the paper price has to catch up to the physical reality, because you cannot deliver paper. You cannot build a smartphone with a futures contract. You cannot make a Patriot missile with an ETF share. At some point, someone needs actual metal. And when the industrial buyers stand for delivery, when they demand physical bars and the COMEX cannot provide them, the paper market dies, and the price goes to wherever the physical market says it should be, which according to the Shanghai premium is already $93. And according to Tom Bradshaw's analysis is eventually $375. So here is what the CME is trying to do. They are trying to create a sell-off today, right now, this morning, to scare you. They want you to see the red candle on your chart. They want you to see silver drop from $85 to $82 or $80 or $78. They want you to panic. They want you to think, oh no, the rally is over. The bubble popped. I better sell before it goes back to $50. They want you to forget about Shanghai trading at $93. They want you to forget about the physical premiums. They want you to forget about the industrial shortage. They want you to forget about Tom Bradshaw's $375 target. They want you to focus on the $5 pullback and panic, sell your position so they can buy it from you cheap, so they can cover their shorts at $80 instead of at $150, so they can survive the squeeze that is coming. This is the last desperate move of a broken system. This is the death rattle of a rigged casino that knows the game is almost over. And if you fall for it, if you sell your physical silver because the paper price dropped a few dollars, you're going to regret it for the rest of your life. So let me be very, very clear about what you should do right now. If you own physical silver, coins, bars, rounds in your safe, or in allocated storage, do not sell. Do not even think about selling. The paper market is lying to you. The physical market is telling you the truth. And the truth is that silver is scarce. Demand is exploding, the system is breaking, and the price is going to $375. If you own silver futures and you received a margin call this morning, you have a decision to make. If you have the extra capital available, if you can deposit more money to meet the new margin requirement, then do it and hold your position. But if you do not have the capital, if you are maxed out, then close your futures position and use the proceeds to buy physical silver. Get out of the paper market where they can change the rules on you. Get into the physical market where they cannot touch you. Physical silver is the lifeboat. Paper silver is the Titanic. Choose wisely. If you do not own any silver yet and you have been waiting for the right time to buy, this is it. Do not wait for the price to drop to $70. Do not wait for CNBC to tell you it is safe to buy. Do not wait for your financial advisor, who probably does not own an ounce of silver himself, to give you permission. Buy physical silver now. Today, pay the premium. Deal with the delay. Accept that you're going to pay $90 or $95 all in when the spot price says $85. Because in 6 months, when the spot price is at $150 and the dealers are sold out, you're going to wish you had paid $95 today. This is not financial advice. I'm not your financial advisor. I'm not telling you what to do with your money, but I am telling you what I see. And what I see is a paper market that is dying, a physical market that is screaming shortage, a Federal Reserve that is trapped, a recession signal with 100% historical accuracy, a macro strategist projecting $375 silver, and a futures exchange that is so desperate to stop the rally that they are changing the rules in the middle of the game. All the signs are pointing in the same direction. All the evidence is screaming the same message. The only question is whether you're going to listen or whether you're going to let fear and manipulation trick you into selling the best trade of your lifetime. The choice is yours, but make it fast because the window is closing. This is John A.G. from Currency Archive. The CME just nuked the margins. The rug pull has been confirmed, but the physical shortage is real. The recession signal is real. The Shanghai premium is real. And Tom Bradshaw's $375 price target is real. Do not let them steal your silver. Do not let them shake you out. Hold the line. The empire is striking back because they are losing. And when your enemy is desperate, that is when you press the advantage. $375 is coming. The timeline is accelerating. The fundamentals are undeniable. Remember to like, subscribe, and share. Get your money out of the paper market. Get your money into physical silver. Do it now. Go, go, go.